Hey, what's up? It's OZ from OzFx, and welcome back to the Smart Money Bootcamp. I feel like a good place to start is with market structure. Knowing how to look at and identify structure in the market can give you a better understanding of where price is, where it's been, and where it might be going. The reason I wanted to start the Smart Money Bootcamp off with market structure is because I believe that smart money traders need to know how to follow market structure, because smart money is typically institutional order flow trading. And if that went over your head, you will understand what I mean by the end of this boot camp. Let's get right into it. So, market structure. There are three types of market structure. We got bullish conditions, bearish conditions, and consolidation. If we are bullish, price will deliver itself in the form of overall, on the higher time frame usually, higher highs and higher lows, while engineering intermediate liquidity along the way. Overall market structure is relative to the time frame you are on. The higher time frames hold the most weight, and structural bias should be formed from the monthly, weekly, and daily time frame. So, in other words, if you're seeing higher highs and higher lows, as I have lined out over here on the daily, even if you're in a downtrend here on like the hourly time frame here, you need to remember where you are at on the daily time frame. And before we go any further, consolidation is just a ranging market from side to side. It's not really going up or going down. Bearish is down conditions, bullish is... If structure looks bullish on the 1 hour, it does not mean that it has to be bullish on the daily. Always remember the higher time frame structure. The market can shift from bullish to bearish very quickly, but we must follow structure until it breaks. We do not look for tops and bottoms. Wait for structure to show you it has shifted. We do not look for tops and bottoms. I'm going to say that again. We do not look for tops and bottoms. We are not reversal traders. We are institutional order flow traders. If you try to be a reversal trader, especially at the beginning before you know what you're really looking for and what's really going on, you are going to get smoked. You're going to keep losing, and you're going to wonder why this strategy isn't working for you. Well, if you're looking for reversals and you don't even know what you're actually looking for, and you don't know what actually qualifies a confirmed reversal, you're going to be counter trend trading every time. We must remember that price is going to deliver itself in a way to trap retail traders. In a lot of cases, price will create intermediate highs and lows in the market, creating liquidity for the market to reach for. When this happens and an intermediate high or low has been taken out, it can be a trap to some traders thinking that structure has shifted. A lot of times because they are counter trend trading before structure has a confirmed reversal. So when price looks like this, taking out a low right here in a bullish structure, a lot of times traders will think that the trend has shifted. They will start looking for sells, but price can do one of three things at this point. So I moved over here to trading view so that I can illustrate this a little bit easier for you, but this is basically the same picture here. You got higher highs and higher lows, a big high right here breaking through some structure, and then you got an intermediate low setting in place right here, followed by a high that created equal highs right here, and then you got a displacement right here. Right? And like I said, there is one of three things that's going to happen. Either you're going to have the reversal actually play out and it's going to go down like this, or it's going to just blow through, because if you look at this, it's just higher highs and higher lows. This low pushed to this high, never made another high, came back down, took this intermediate low. This is the extreme low of this specific swing right here, right? This is your range from here to up here is your trading range, right? So for all you know, there's an order block sitting right here, which most likely there is an order block. That price is just going to come down, take the liquidity right here, and keep moving and blow through the equal highs that are sitting right here. Or the other thing that could happen is it just starts to consolidate right here, something like this, right? So let me walk through that again. You got higher highs and higher lows. Sets in an intermediate low, right here, comes back up, does not make another high, and then we do make a minor structure shift right here. Yes, you could look for some sells right here, but you're going to want to look for some lower time frame confirmations. Maybe it would start to consolidate here and eventually drop. We're not going to talk the what if game right now, but in most cases, this, what I've drawn right here, maybe this, maybe going higher, of course, breaking through these highs right here. This is what you're normally going to get right here. Now let's get rid of all this. I want to show you why multiple time frame analysis should not be overlooked. Remember when I said price was going to make higher highs and higher lows on the higher time frame if we are bullish. Now if we are bullish on the daily, in some cases we can expect to see the 4 hour in a different, smaller trend. Let me show you what I mean. Alright, so I'm going to start and I'm going to draw higher highs and higher lows, right? And we're going to say that the black is the daily, okay? All right, so the black is daily, and the red lines that I'm about to draw are going to be the 4 hour, and I'm about to illustrate to you what I mean. This red right here would be the 4 hour, right? And you're going to have smaller swings in each one of these daily swings, taking out structure along the way, which is why I said structure can shift from bearish to bullish very quickly, but you got to have in mind the higher time frame structure, right? 4 hour keeps going back up, going back down, back up, and as you can see, you have intermediate price swings and intermediate liquidity along the way. In each one of these daily swings, we are going to have smaller 4 hour swings shifting back and forth between bullishness and bearishness, while the daily bullish structure points are ultimately holding their place in the market. And why is that? Because there's probably order blocks in here, one right there, probably one right here. There's order blocks probably at every single one of these swings. There's imbalances in each one of these swings. The market has a reason to go down. Whatever that reason is, you're not sure, or we're not sure until we actually go and investigate it. Okay, so here we have a real charting example that I want to show you, and this is a DXY. Don't worry about what it is, but we are on the daily time frame right here. And as you can see, we got higher highs and higher lows. So I'll just start from here. High, low, high, low, high, low, high, low, high. And as you can see, each one of these highs and lows are higher than the last. This high, well, I guess this low would be higher than this low. This high is higher than this high, low higher than this low, and so on, right? Now, if you go to the 4 hour time frame, let's see what we got here. See? Now, if you were just coming onto this chart right here, and this is all that you were looking at, let me get rid of this line right here. You would be believing that price was starting to break down, right? So because you got breaks, you got a break here, you got a break here, you got breaks here through all that liquidity there. You even got a break there. Let's see, you got any more breaks? No. And then that's the last break. And what's it ultimately do? It's coming back down into an area of demand in here to go up to the top side and continue bullish. Now, does that mean that you can't counter trend trade at all? No, you can, but I'm going to recommend that you study a while before you start doing that, and you get some experience under your belt before you start counter trend trading, because you got to know when to get in, when to get out, and you got to know how to follow structure, and you just got to be a little bit more in tune with the market to be able to do that. That's not something that I recommend anybody doing. I don't even like doing it. I only do it if it's a good opportunity. But most cases, I'm trading with the trend, institutional order flow. If it's bullish, we are trading bullish until it is not anymore. We need a confirmed bias or a confirmed reversal to show us that price is moving. Now, let me show you an instance where you might be able to look at a confirmed reversal, okay? Let me go back to the daily. Okay, whoops. Now, as you can see, we've taken out a major daily swing point. We're even about to take out another daily swing point. You could now technically start looking for sells. Now, does that mean it's ultimately going to sell off? That's not what that means. But you have a much better chance of this turning bearish than if it only took out these lows right here and then came here and went up to the top side. But that's not what happened. It continued to take all this liquidity over here. When you're looking at the charts, just start looking and analyzing market structure. Go back in the replay mode, see what you can find. And that's all I got for market structure, guys. I'll catch you in the next one.